All right, so now we're going to cover the bank reconciliation journal entries. In other words, based upon what we did here, quick recap, we got to book all that. So first we'll start with the note that was collected. Right, so that's going to look like, so in other words, we collected $10,500. We're going to debit that, credit notes receivable for 10, and then recognize interest revenue of $500 on that one. And then next up, what do we have? We had three subtractions here. So we had a subtraction of $15.35 from the NSF check. So we got to subtract that. So what we're going to do here is we're going to reinstate, the accounts receivable for Heat Company for the full amount we were charged, and then of course subtract that amount from cash as well. Next up, we have our service charges right there. So that's just going to be a small amount. So we'll just put that in miscellaneous expense, debit that, credit cash. And the $9,000 that we were off, remember, it was an AP clerk that made a mistake, if you recall from that. So that's why it's going to be what? So that means we're going to be debiting $9,000 out of accounts payable, crediting cash for the same. After you book all of these entries here, which is journalized and posted, your cash balance will now equal the reported cash balance and the reconciliation, $147,835. So again, whatever we had here, whoops. Still struggling to control the mouse when I'm doing this. There we go. So now they equal. So think of that as, again, it's a source document for doing some adjusting entries at the end of the period. All right, now the next subject matter here is voucher systems. Again, what are we doing here? We're trying to control cash payments. So that's all a voucher system is, a way to verify the legitimacy of each payable, and it's a way of separating duties in sensitive areas like cash disbursements. I talked briefly about that in an earlier video about separation of duties. We'll elaborate that with vouchers in a moment. Right, so here's the example that we're going to work with. So we have Hosa Corporation purchase a new moving van for cash, $145. The receiving department contacts a payables clerk capable of entering new vouchers into the system, meaning all this clerk can do, this is it, enter accounts payable credits. We're obviously discussing a larger organization that has that capability of having be that compartmentalized. Smaller organizations are not going to have that latitude, they're not going to have that personnel at their disposal. But in this case, we have that. So this clerk is going to collect all the critical info. So that'll be name of the company they bought the van from, copy the invoice, etc. So when we talk about the concept of a voucher, that's all it is. It's all the details of the transaction, everything conceivable. We'll just go in there. So we'll enter this into the system, and we use pre-numbered documents, or in this case, a pre-numbered sequence. May not actually be a physical document, in this case 7143 as our voucher number. So this is what the AP clerk will enter into the system. So they'll debit delivery trucks and a credit accounts payable voucher 7143. All right, so you note from the previous slide here, again, this was for cash. So because of that, this will be tagged as immediately due. So it'll pop up on the screen of a clerk capable of entering cash payments of vouchers. So all this clerk can do is enter accounts payable debits, and the other half, of course, is going to be logically cash credit. That's all they can do there. That's the extent of their duties here. Now, this amount, $145,000, is a little excessive, so we're not going to let a clerk check off on that, right? That's another part of your internal controls here, is you have a threshold for transactions over a certain amount must be approved by the treasurer. So we're going to have to contact the treasurer and get their authorization. So what are they going to do? So they're going to look into this, right? This is a large amount of money, so they're probably going to call down to the department that received the truck and ask, hey, did we actually get this moving van? Yes or no? Okay, everything's in order. So then they'll sign off on the payment. In this case, it'll be check 4548, and now the clerk will enter this into the system. Important to note, treasurer can't enter anything in the system. There's a reason behind that we'll talk about in a moment. So this is what the clerk's going to enter. So accounts payable, what was the voucher number? 7143 for 145, and then cash credit for check number 4548 for the same amount. So look what happened here. We had 4 different parties to a single transaction because we had someone in receiving, You had 2 clerks and a treasurer. Now again, physical custody of assets were separated. This was very important. In other words, the people who took physical possession of the truck was one department, and the treasurer was in another department. Neither one of those departments or people had any ability to enter anything into the accounting system. That's one thing we want to do. Custody of assets and record keeping should be separated, because that's a big risk. Now, does this mean that the company, in this case HOSA, is impervious to malfeasance, that they cannot be the victims of any kind of a theft? And the answer is no. Workers can still collude and steal, but with collusion comes what? The risk of somebody getting honest. So what we're trying to do here is to deter theft. The more people you include in a caper, the more likely that somebody might get honest and turn everybody else in. So because of that, things like we're doing here, separating duties, adding more people to a transaction in a sensitive area, we reduce the possibility of theft. You can't eliminate it. You still have the human factor at work. You can't eliminate it, but you can make it more unsavory for people to steal from you. Other things that will help you avoid theft is going to be rotation of duties when and where possible. Probably not, like rotating a treasurer, probably not something you can do, but within the accounts payable department, sure. So in other words, those 2 clerks that were doing either AP debits or credits, you could have them periodically switch what they do. If somebody gets a little bit upset about that, they might be, involved in some sort of a caper to steal from the company. This one seems strange, but there's logic to it as well. Mandatory vacations. You make people in the department take a vacation. Hey, this is going to be your vacation period. You're going to take a couple weeks off. If they resist, big red flag. Why? Because, like I said before, with the rotation, if they resist that, there's something going on there. They don't want somebody to look at their work, because if somebody looks at their work, they'll be like, hey, they're actively stealing from the company, possibly with the assistance of somebody else. And the way I always like to think of it as, they don't want to go on vacation because they're on vacation already. They're vacating money from your company into their own wallet. They don't want to stop that and get caught, obviously. And another thing important, big companies for sure, internal audits, which means you have somebody that can look into the system. They can't impact it. They can't enter anything into it, but they can look at it. They can take a peek, see what's going on in there, especially in the case of chief officers and whatnot, who usually have total system access. They can look and see, what are they authorizing? What kind of transactions are they involved in? Because if they were going to steal from you, it will show up there. Usually it shows up in what looks to be a legitimate transaction, but is in fact just, a smokescreen for a theft. So we'll talk more about the internal audit function briefly in a later video. All right, so from here on out, we're not going to use frame anything in terms of the voucher system just for brevity's sake. Otherwise, it gets a little bit, gummed up, so to speak, when we're trying to talk about and focus on something else. All right, now we will begin the concept of a change fund, and then I will hand this off to the next installment. So change funds, again, we talked about that earlier as a possibility. So again, if you're going to have a storefront, a brick and mortar store, you have to establish a change fund as cash on hand to make change in your cash register. So again, we're going to have Wonder Software establish a $500 change fund for their registers. Simple transactions, just change fund debit, cash credit for $500. So now that money is where? It's no longer in the bank. It's now on the premises in your brick and mortar store. And with that, I'll conclude and look to the next video for the continuation of this concept.